day, everyone. Thank you for joining us once again here at Seafood and Brew for our economic briefing. This week, we're going to review over the Fed announcement of their tapering, look at the jobs report that came out this morning, and then see what the impact to the 10-year Treasury has been throughout this week. So we know that the Fed came out on Wednesday with their release that they are going to start tapering this month in November, and then also follow that up with another reduction in their asset purchases in December. So overall, we know as of right now, the balance sheet is about $8.6 trillion. But we know that it's going to continue to grow at least through the middle of next year. And so that's when the tapering kind of rolls out. So they're tapering this month. If we look at the projected schedule in terms of their purchases, currently they had been buying about $80 billion in U.S. Treasuries and $40 billion in mortgage backs for a total of $120 billion a month. They're going to scale that back by about $10 billion on the Treasury side a month, and then $5 billion on the mortgage back side. So for November, $70 trillion they'll be buying in Treasuries, and then mortgage backs at $35 billion. So we're going to follow that up, and then they said on December they will look at reducing that another $10 billion for Treasuries and $5 billion for mortgage-backed securities. They did have in their language that they expect to continue this reduction in the months coming, but that they will make that announcement as they move along, and it will be contingent upon the economic activity that we see in the future. But if we follow this out throughout the next several months here, we can see to the end, their last level of purchases would be May of 2022, where they would have that $10 billion in Treasuries and $5 billion in mortgage backs left over. And then in June, they would stop purchasing that additional money. Now, that's not to say that they're going to reduce their balance sheet at that time, but it will suggest that they will just stop increasing their balance sheet, and they would have to continue to reinvest the money that is rolling off. So at this point, we estimate about $9 trillion in their overall level of assets at the Fed. So if we follow this through and they do end their purchases in May, with being the last month that they will be purchasing, then in June we'll see that $9 trillion balance sheet that will have to be sustained moving forward. Now with that, we follow that up with the employment report. Very positive news on the employment report. Overall, we saw the unemployment rate drop down from the 4.8 in September to 4.6 in October. We had a strong number of non-farm jobs created at 531,000 jobs. Very strong in here, much higher than was projected or forecasted. So that's a big positive. A lot of those positions, a lot of those jobs came in forms of that leisure and hospitality, bringing in 164,000 jobs. That's a huge number. We'll see if that continues as we move through November and December. This is coming off of, if you recall, the slower job numbers because of the Delta variant pulling off, but that's very strong, 164,000 in the leisure and hospitality alone. We had a couple other bigger numbers, manufacturing up about 60,000. The transportation and warehousing, that increased by about 54,000. And then we have that education and health services up 64,000. So we see this progress moving forward in the jobs market, and this is something that the Fed kind of indicated on their in their release, and Chairman Powell giving his his conference afterwards, talking about that full employment number. When will we get to that full employment? And that is when they're going to look at then thinking about those interest rates and potentially tightening up on their interest rate policy. Most likely that will not happen until the asset purchases, the additional asset purchases are done, that tapering's complete. So we're looking at the earliest in the middle part of next year, but I think it's going to be pushed out a little further, maybe into the third, early fourth quarter of next year. So we'll look and see how we progress moving forward on the economic growth of that GDP, as well as the unemployment and that inflation number that continues to be high. However, the Fed continues to speak to the terms of that still a transitory type of inflation. We're in this process right now where we have this supply bottlenecks and issues there that's creating this upward momentum in that inflation. So we'll see if that pulls off at the beginning of next year. When we look at the hourly rate and the hours worked, we know hourly earnings came up to 30.96. That increase about 0.4% month over month. Could be subdued a little bit because of the number of jobs created in that leisure and hospitality, which are typically lower paying jobs. So that number could be constrained in here for this month. We'll see if that continues to increase in the coming months. But still, year over year, looking at close to a 5% overall growth rate in that hourly earnings. And then we had weekly hours worked up, or came down slightly from 34.8 to 34.7, just a slight decline there. But overall, very positive employment report here. GDP Now, we looked at this last week when we looked at the third quarter GDP release. That was, if you recall, at that 2% or that 0.2% for GDP. When we look at the fourth quarter one for this quarter now, very aggressive in my mind, looking at a projected 8.5% growth rate in GDP in the fourth quarter. That's very high. And this tends to be very volatile when we look at it in the beginning stages. Remember, we only have a couple of releases that come out for fourth quarter numbers that are feeding into this. So this number is a little higher, but interesting when we look at this growth projection here, the fourth quarter, and we make that up, or take that up against the chart we had last week, or what would the fourth quarter GDP have to be in order for us to meet the Fed projection for 2021 GDP growth. Remember, that was 8.2% we saw last week. Right now, that GDP Now putting that at 8.5%. So I still think that's a little aggressive for the fourth quarter. I think that's going to come down as we progress through the quarter and more data gets released. But what did the Treasury do? The 10-year Treasury, how did it react? Interestingly, when we see this period here, this would be the time period that the Fed came out and released their statement. Not much movement here. We got a couple of basis points up on the 10-year Treasury after the release of their tapering and the current schedule for the next 2 months. So we had a little bit of upward momentum. We knew that was built in. Basically, when we think about the Treasuries, we expected this tapering to begin. So we had that little bit of an increase. But then look where we are coming down throughout the remainder of the week. And then after the release today of the good jobs number, interestingly, we did have a decline in that overall 10-year Treasury by about 3 basis points. So pulling that off, little counter to what we would typically anticipate on such good news. Stock market continues to move up as well. So we have this downward trajectory, and that raises the question, how much higher can the 10-year Treasury move? Will we see a 1.7, 1.8 10-year Treasury by the end of the year, or potentially 2% sometime in the first quarter of 2022? I'm in the camp that might suggest no, we're not going to see those type of movements in the 10-year Treasury. I think we're still a little capped below that 1.7% 10-year Treasury for the time being right now, unless we start to see some really aggressive economic numbers coming out that would indicate future growth and sustained future growth in our economy. And then the big piece of the puzzle that we have to work in here is that inflation number. Do we anticipate that inflation rate to remain up here for a prolonged period of time, not just quarters, but I'm talking years? And I don't think we're there just yet. And we look at the forward inflation numbers, that five-year forward inflation expectation number, that still remains below that 2.5%. So I think that still raises up some questions in my mind if we can continue on an upward trajectory in that 10-year Treasury. And as of right now, I have to say, no, we can't. Another question that we have is, what about the Fed and the increases in their Fed funds rate? I still think we can build in one increase later next year, and maybe potentially, depending on how the economic numbers come out, maybe a second increase in December of 2022, maybe going into 2023. So that's where we are here. And you talk about budgeting. That's where I would indicate our budget would be budgeting in one increase in the Fed funds rate sometime in the third quarter or early fourth quarter of 2022, and then potentially, if we get really strong numbers, a second one in maybe that December meeting. So that's what we have for you this week. Thank you for joining us. Next week, we'll talk about the performance of that community bank benchmark group for the third quarter. Those numbers were released this week, and we're excited to present that to you next week. Have a good weekend, everyone, and I'll talk to you next week.